Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the markets associated with the metals. And looking back at last week's excellent charts, it may appear as if not a whole lot has changed, but in fact, we have had some volatility. We have had some price swings, and yet we're sort of back where we were this time last week. Gold is bouncing up against that 1800 figure again. Silver's holding strong over 22. Platinum is remaining over 1,000. And so with all of that, let's kind of dig deeply into this week's charts and show us what's transpiring.
Not exactly the action I think we would have expected in November and December. I think that's kind of fair to say. Yeah. Every time I say seasonal markets are a lie, they do exactly what we think they're going to do. And every time I say seasonal markets happen, they don't. So here's gold up.
The beauty of predicting.
Low 1600s to almost 1800 now through November and into December.
Well, and that's wonderful. Gold, think about that. Gold's up 12% from those September lows. Find another market, right? Well, we'll get into silver.
Yeah, the dollar. It's down 8.5% in the same time frame.
Down, but silver's up 30% in that same period of time. So I skip ahead. But anyway, with the gold price action, great charts last week. Let's review some of that.
So last week's show was a good place to go back if you want to. Otherwise, what we're seeing is kind of some confirmation of our expectations going forward in the metals. So after we recorded last week, I think it was on Thursday, we did have gold come in and kind of put in a second high going back to the August highs right at around 1800 or just under it. We've had a little bit of a pullback, but not much. And today, lo and behold, it's right back up. So gold definitely looks strong. Now, when you bring in some of the indicators like the RSI, the Relative Strength Index, you see that we're actually starting to see some topping actions. Maybe we're going to see a couple more bouncing highs along a rising trend line into maybe my expected price around 1850 and then a reversal back down. So my gut tells me, and we'll get into this when we look at the silver price because I think that's kind of leaning us towards it. I think we're going to see things kind of calm down here for a few weeks. We've had an exorbitant push up, as you just mentioned, over the last month in gold. We've had a very strong push. Would you say 12%?
12% gold, 30% in about
insane.
2.5 months, really. I'm giving credit where credit's due, going back to the September time frame.
Sure. Yeah, when we started to find bottom back in September and then turned around. So I would expect to see gold kind of calm down here. Again, I shouldn't use the S word seasonal, but we're 3 weeks away from Christmas at this point. And
give us a Christmas present. Bring
exactly.
it back down. I know
that's the problem, though, right? Is because I still have Christmas presents to go buy. I'm not buying gold this month. I'm buying Christmas presents because, I might buy gold, but it'd be a different form of gold. I have to get my wife something still. So that's kind of my expectation going forward. I'd like to see gold kind of bounce around, bounce up. I still want a nice correction in gold.
I do too.
I want to pull the bowstring back, so to speak, because I think there's a really good argument, especially since we're bumping against those August highs. There's a real good argument that we're seeing a reversal here, and I think the dollar chart and the silver chart and the platinum chart are going to point towards that as well. And the stocks. So we have to look at stocks also.
I would love to see that 1720. Just that alone would be just a welcome opportunity.
It doesn't even have to be big. It doesn't have to be something aggressive, just something that kind of cools the market off for a split second and allows people to kind of reload. Silver, on the other hand, isn't giving us any semblance of cooling off. As silver, we had our breakout move up, getting above those kind of May, June highs before we had that last move down. Silver is now up, as you mentioned, about 30%, going back to the September lows. And silver never really, we had that triple bottom in gold. Silver didn't do that. Once we hit that September low, we just started bouncing up, and we haven't stopped bouncing up. Silver will eventually also need to take a break, but silver may not be done. We may get one real aggressive sort of logarithmic push up, where all of a sudden in 2 or 3 days, silver's up $4 or $5. And then have some type of aggressive move back down. So
I remember those days well.
Yeah.
And keep in mind, too, keep your eyes on the ratio there, right? Silver has outpaced gold because we were at a 95-to-1 ratio.
Mm-hmm.
Now we've come all the way down to 77-to-1, as represented by that 30 to 12% overperformance compared to gold. it'll be really interesting to see where that ratio bottoms here on this most recent cycle, because in 2021, we got as low, obviously, as 62 to 1. Are we going back there? Long-term 50-year average is closer to 58 to 1. So we're still 20 points to the favored side of silver outperforming. But yeah, you're right. And with this recent climb that you're describing, this heat in silver, what happens is you tend to, in a high demand, low supply market, you see premium spike. And anyone buying silver in the last 6 months knows exactly what I'm talking about. And we've talked about it on this show. Silver has gotten very expensive. It put a floor in. And yet when the spot price climbs, it erases that premium, right? It starts to evaporate the premium. And lo and behold, you know, like Silver American Eagles, the bid on Eagles is down from 55% to 35%. There's a 20% reduction in premium.
Yeah, when you started talking about the ratios, I almost interrupted and said, not in coins.
Not in coins.
Because the coins are starting to tighten.
Yeah, junk silver, same thing. I mean, that bid came down from 38% over spot to 7%. So that's a huge decline, and that's all because of that spot price climb.
Right.
So if there is a turn down, don't expect to really be saving. In the coin world, it's sort of dictated its price, and you're going to pay what you're going to pay. But congrats to all those of you, client-wise, who rang the bell, and you picked up anywhere from 15 to 40% more ounces for free with us. That's been a really fun takeaway in the last 2 months.
Yeah, that has been fun to do. It's nice when those things pop up from time to time, especially being in the precious metals brokerage side of things, to have clients that can turn one product into a whole bunch more of another. And we had a lot of listeners and a lot of clients call us in on that. So we'll certainly going forward to try to keep you guys abreast of anything else coming up.
Yeah. Ironically, I guess what we're saying is the higher the spot price climbs, if we do take off and
it's catching up with the
better
premium.
the value in silver actually becomes.
Right.
Yes.
So as that spot price continues to rise, I think there's a good shot we could see like $25 on silver here. Just with the momentum we have, we could see a push somewhere into the $24.50 to $25 range before we see any type of major ceiling. But then hang on, because that's a lot of movement. I mean, we're talking 17 to 25, 26 with no real downwards pressure. So there's a good chance if we see some type of topping action around there, the reversal would be pretty firm. But again, that's just pulling the bowstring back.
And that'd be a ratio of about 74. So you're looking at a few more points erased on that gold-silver ratio.
Right. Moving over to platinum, last week I threw out a chart with kind of what I think the perfect platinum chart would look like going forward. We're still moving that way, but we've had a little bit of a pause here, a pretty aggressive pause. I mean, we've had two ups and downs between like 1,000 and 1,080. I'd like to see that continue to push up to meet this long-term declining ceiling, which would probably push us up into the low 1100s. That was kind of my expectation last week. But the other thing that could happen here, because platinum had been so overbought, is we could just continue to trade sideways. You can see how we're starting to build a little bit of sideways trading in platinum now. We had a lower high and a higher low. So that means you start to build a low compression, almost like a wedge pattern that could end up forming here, which would likely turn into a breakout up. So we don't necessarily have to get my perfectly played out platinum chart from last week. We've got to shake the overbuying out somehow. And this is the other way we could end up doing it. So if you see platinum start trading sideways up or down 50 or $100 over the next few weeks, I'd actually be looking for entry points in that on the platinum side, because we may not get a pullback. You don't need a pullback to get buyers out of the market for a short period of time. You can just have a lull, and a lull accomplishes the same thing.
Well, keep in mind too, the more platinum stays flat, if gold and silver continue to climb, that makes platinum that much more of a value.
So with metals going up, what isn't?
You said it earlier. I'll answer your trivia question.
Yeah.
The dollar.
Yeah.
The dollar is actually down 10% from its high. And that plays right into a really good image. You know, a couple months ago, you had put up a great chart of sort of that X pattern between the dollar and the gold price. And as the dollar climbs, the gold price tends to come down in just a normal market, especially in a shorter term interest rate hike environment where the dollar is rallying and other central banks have yet to catch our central bank's processes and policies. And look at this chart. It's so great. So you had this big X where gold was declining and the dollar was rallying. And we said that cannot last. It may at some point go higher, but it's got to take a breather. That's what we've seen. Now look, as the dollar has taken a breather and we've gone from 115 down to 105, a little bit lower actually. And lo and behold, that gold price, obviously that's that bottom at around 1600 to where we are now at around 1800. Really good image to encourage the gold investor why gold is such a good hedge on the currency against which you measure it.
You know, you're going through that and watching how the dollar and gold do at least expectedly have like this inverse relationship, right? And it just immediately made me remember back about 2 years ago at the beginning of COVID when we tanked interest rates and the dollar skyrocketed. And everybody was asking, why in the world are interest rates going down and the dollar is going up? And it had to do with all the other global factors, right? The US dollar, regardless of its payout, is seen as a safety net and as a hedge against just about everything else globally. Well, what are we seeing right now? We're seeing the exact opposite of that, where interest rates are going up and interest rates are expected to continue to go up and the dollar's going down.
Yeah, and I'll tell you this too. I think that the next time we put this type of chart up, there's a really good chance that you're going to see gold and the dollar going the same direction.
Sure.
Because that happened in 2008. The financial crisis hit. Gold initially came down 25%. By early 2009, gold had bottomed and had already started reversing. The equities, the stock market didn't begin reversing until about May, where it put in its final low. That whole time, though, the U.S. dollar had driven gold down in the end of 2008 because everybody flew into the U.S. dollar. Everybody goes to cash. Well, gold initially took a black eye, and then it just started climbing. And it climbed and it climbed and it climbed and it climbed all the way into 2011 where it hit its all-time high. Well, that was coinciding with the continued dollar rally until you started to see the dollar roll over as a result of TARP and the initiation of quantitative easing 1, 2, 3, and that's what started putting the metals to all-time highs. But until the dollar finally found that top, it was actually going with gold. So wouldn't surprise me one bit at this next cycle if we see continued equity market weakness, if we get another big turn down. I don't think gold follows this time. I think it goes with the dollar.
Yeah, and it's good to remember that too because, you know, markets aren't binary in that it's either this or that. Money moves between a handful of very large markets. You know, we've got our equities market, you've got the bond market, which is all affected by interest rates. You've got currencies, you've got the real estate market, you've got things like alternative assets like precious metals or cryptocurrencies, if those are even going to be a thing in a few, but that's a different conversation. We'll leave that alone. I know there are people still suffering trying to get money out of their FTX accounts. And then you've got all of those things that exist in the foreign markets as well, in Asia, in Europe, so on and so forth. So I think it's a great point to bring out because you can see markets that traditionally you think are binary to each other moving simultaneously, parallel to each other because of some major catastrophe happening somewhere else like we saw in the 2008 stock market crash. So don't assume that interest rate rises always mean X.
That's right, especially in the instance of a black swan event.
Exactly. So finishing out the dollar just because I love when this happens. I also last week put out a My Perfect Dollar chart over the next month or two. And I said, you know, I'd like to see a little bit more down movement, then a pullback up to around 109, 110 and build this like kind of gorgeous reversal head and shoulders pattern, which everybody knows what that is. And let's be honest, we don't see them as much as we'd like to. So no clue if this is going to play out or not, but I did get the first step I needed to make that happen, and we did have it dip below the August lows. So it only happened for a day, but we had it dip below that August low, just over 105, like 105.1, and went down slightly below that. Now we're back above it, but I'd still love to see the dollar push down a little bit more here, have a strong reversal back up, which dies at around 109, and then we're off to the races down, maybe back into the mid-90s. So don't know if it'll play out that way. We'll see. The market, I don't thinks that'll play out that way when you look at where the yield curves are right now. I was looking at this earlier when we were talking about the dollar, and I thought this was worth bringing in. So I just want to show this chart. Maybe we can talk deeper about it next week, but we've been talking about some of the yield curve inversions. I know David and Kevin had a long conversation about interest rates yesterday on the McIlvaney Weekly Commentary podcast, so make sure you catch this week's episode of that. But you can kind of see how you expect your long-term interest rate yields, what you're getting paid back on the investment, is going to be a little bit higher the longer you own the investment, right? If you're going to lock your money up for 10 years, you should get paid more than if you're going to lock it up for 5.
Or 1.
Or 1. So you can see that's pretty normal up until about, halfway through 2022. So what has happened since we've started raising interest rates is we're seeing this massive inversion to where your 10-year and your 30-year yields are still at relatively reasonable levels,
and very similar.
And very similar, yeah, stacked right on top of each other. But the 5-year has pushed above those two. And look at the 1 year. The 1 year is 1.2% higher than the 30-year. So the market is expecting to see interest rates continue to rise definitely over the next year. And this is what David and Kevin were talking about yesterday. We absolutely know interest rates, things are going to get worse for the next at least 6-12 months. Well, the 5-year is at a higher rate too. So the market is fairly confident that they may even continue to raise interest rates for the next 3 or 4 years, maybe even 5. But the odds that 6, 8, 10, 15 years from now, interest rates would be higher than they are today, no way. There is nobody in the market that thinks that's possible. Because if they did, the 10-year, the 30-year, those would all be at higher numbers compared to the 1 year.
So it really doesn't even matter what the central bank is saying when they stand at the microphone. They can change the Fed interest rate, but the real interest rate market is this market, right?
Yeah, where are people spending their money?
That's right. And that's where they lose control. That's where the bond market bubble bursts, because they lose control of that interest rate market.
Right.
Very powerful image.
Yeah, hope and delusion.
Yeah. Well, it doesn't look like we've had a whole lot of change here in the last week in the precious metals when you just go week over week. But there has been a lot of volatility in other markets, and the equities are no exception to that. The Dow's down 1,000 points this week, down 2.7%. The NASDAQ's down 4.6% in that same period of time. And the news is getting worse. I mean, not just in terms of the recession concerns, but the technical predictions. I'm not a stock market expert in terms of analysis and all that, but everything I'm reading is predicting anywhere from 20 to 40% in terms of a further reduction in the equities markets. Not the place to be parking. It's not the place of value yet. David and Kevin have talked a lot about on the McIlvaney Weekly Commentary. You know when equities are a value? When we're at least below 10 to 1 on the Dow to gold ratio, meaning the Dow is 10 times the price of an ounce of gold. That's when you'll know that you're seeing real value in the market. But yeah, anything to say in terms of equity volatility this week?
Not necessarily. I mean, from purely charting standpoint, the volatility is pretty reasonable thus far. Well, I mean, the Dow has been screaming back up. Relatively, it's still got a long way to go. So we can talk about what the Dow's done, since it bottomed out back in, October?
Yeah.
But compared to where the top was in the beginning of 2022, who cares? We're still significantly down for the year. It's just, like you said, volatile. Volatile, I guess, is the word of the day.
Just don't believe the hype yet, right? Same thing with oil. Oil's gotten crushed. I mean, it's gone below 75 a barrel, 72.46 actually today, down 2.5%. But that appears oversold, and I think we get a rally there. That's a little bit different. Gold, again, just to kind of circle all the way back around, watch what the central banks are doing, not what the central banks are saying at the microphone. What are central banks doing? They're continuing on this record pace of physical gold buying. So China always helps put the floor in the gold market, and they just added 32 more tons, worth about $1.8 billion. So we just had a record third quarter, right? 400 tons of gold acquired by central banks in the third quarter when there was 463 acquired in all of 2021. So now Q4 is shaping up similarly, just with the October numbers. And for me, this is almost a guarantee that we're going to now be 13 consecutive years of net purchases by central banks. Take that backwards. That's financial crisis. Nothing has been fixed. This game continues. They're scrambling. They're trying to keep pieces in place. They're looking at things like currency alternatives, digital currencies for central banks. Take a look at Project Cedar. There's all these creative ways that they've got to try to keep the house of cards propped up. And ultimately, all we can do as individuals is put ourselves on the gold standard, because they're not going to do it. So we as individuals have to do it. And that's the encouragement for today. Seek privacy, seek purchasing power preservation, seek value, and it's still in the gold market.
That's going to do it this week for Golden Rule Radio. As always, we appreciate you stopping by. If you liked what you heard, hit the subscribe button, ring the bell. You can find more info on our website, McIlvaney.com. We're on Facebook at McIlvaney Financial or Twitter at ICA Gold. And as always, if you'd like to discuss your personal portfolio, give us a buzz at 800-525-9556. Thanks for listening. Have a good week.